Hello and assalamu alaikum everyone. In today's lecture we're going to talk about statement of financial position. Previously we talked about income statement and all its contents etc. Now it's time for statement of financial position, which is another important document published in published accounts. So what is statement of financial position? It is a financial statement recording the assets, which are the possessions, and liabilities, which are the debts of a business on a particular day at the end of an accounting period. So it is basically a record of your current and non-current assets, which is everything a business owns, current and non-current liabilities, that is simply put everything a business owes, your working capital, reserves and equity, which is a reflection of the worth of a company. And if someone is confused with the term statement of financial position and is more familiar with balance sheet, you can just refer to that as well, but we'll use this term of statement of financial position. Still, just for information, this was previously known as balance sheet. Now, statement of financial position only represents a picture of a business's assets and liabilities at a moment. So you can say it's a snapshot of the financial position of an organization. Because of these statements always carry a date on which valuation of assets and assessment of liabilities took place. Okay, so unlike the income statement, which is like a record of the year, this is a one moment in year. Okay, so it could be that at that particular moment where this was drawn up, the snapshot was taken, the business was having good condition, like it was having a good performance compared to the rest of the year, or it could be opposite as well, that business was performing good all year round, but at that particular moment it was not good enough. Okay, so that's why this could be a little misleading. By recording assets and liabilities, statement of financial sets out the ways in which the business has raised its capital and the uses to which the capital has been put. So that's basically the whole idea behind this, that it tells you how the business has raised the capital and where has the business put that to use. So let's move on. This is the particular format of your statement of financial position. Sorry, it's a little rough, but I hope you get the idea. Okay. Now the main contents of your income statement of financial position are your assets, and assets themselves are divided into your non-current assets, which are also known as fixed assets, and your current assets. Then you have your liabilities, which has three components basically: current liabilities, non-current liabilities, and shareholders equity, which is kind of considered part of liability because total assets is equal to this total equity and liabilities, but sometimes it is considered a different part, not just not part of liability. So you can say that as well. You can say there are current liabilities, there's non-current liabilities, and then you have your shareholders equity. So all of these total equity and liabilities will be equal to your total assets, as can be seen over here as well. Now as you can see over here, non-current assets themselves have some little things over here: property, vehicle, equipment, intangible assets. Then there are some parts of current assets. Then there's current liabilities as well, non-current liabilities. Everything isn't broken up in parts. Okay, you can see this thing over in your course book as well, the diagram, for more better understanding. But right now we're just having a look of what are the components of it and how we assess this. Okay, so now let's look at each of these components in detail. Now we have assets. What are assets? Assets are simply something that a business owns. There are two main categories of assets, these that are your current and non-current assets. So what are non-current assets? The assets owned by a business that it expects to retain for 1 year or more. So these are also called your fixed assets, as you have seen in that balance sheet. These are used regularly by a business and are not bought for the purpose of resale. So whenever you purchase these assets, non-current assets, you don't have the intention of selling them again. Okay, you want to retain them for a long time, such as you see over here, property, vehicles, equipment. Okay, you don't want to just sell them off, you want to keep that to yourselves. So examples include land, property, production equipment, investments, intellectual property, and vehicles. All these are your examples of non-current assets. These are not easily convertible to cash or not expected to become cash within an accounting year. So you can't just convert them to cash unless you want to sell some stuff, and selling land and property as well takes time. Investments cannot be directly converted to cash. Okay, so these are intangible or like already happened. They themselves can have three categories. So they are intangible, tangible, and natural resources, or sometimes instead of natural resources we have financial fixed. Let's just go over each of them. Intangible are the goods that have no physical presence, such as your goodwill and brand name, although they may be created, such as patents. Okay, so goodwill and brand name are parts of your intangible goods, and they are not written in the balance sheet unless they are created. Okay, created, they are given a physical form, such as patents over here. So as you see over here, there's a little section over here called intangible assets. So that was not all of the intangible assets, but some of which that was given a physical form, that was converted to cash. Then we have tangible assets, that are physical assets or property owned by a company, such as real estate and equipment. So all of the above was your tangible assets. Then we have natural sources, like assets that come from the earth, such as fossil fuels and timber. Now intellectual property and investments are also part of your intangible assets, or you can say you can give them into a further subcategory called financial fixed, but we don't go into that much detail. We just need to know that non-current assets, and there's something called intangible and intangible non-current assets. Okay, all of this data over here. Then the other category we have is current assets. This category of assets is likely to be converted into cash before the next statement of financial position is drawn up. Okay, so before the, that is after, within 1 year. Okay, since statement of financial position is issued each year, so this, all of the assets which are converted to cash or in the form of directly cash are known as current assets. Assets that can be converted into cash within 1 year. Okay, don't forget that point, because assets which take more than 1 year are your non-current assets. Therefore, cash, accounts, receivables, and inventories are examples of current assets, as they are only retained by the business for a short period of time. Okay, so you have them for a short period of time. Accounts, receivables, and inventories, quickly they become cash. Inventories sometimes take more time. Okay, but still they are converted into cash within a year. So that's why they are all part of your current assets. These are important to businesses because they can be used to fund day-to-day business operations and to pay for the ongoing operating expenses. So current assets are basically what the business uses to pay for its day-to-day expenses. As if if you remember the concept of working capital, we have discussed that before in sources of finance chapter. And what was that? It was the finance used to pay for day-to-day expenses, right? So working capital is that it can be calculated from the statement of financial position by the formula working capital equals to current assets less current liabilities, and it is also called your net assets. Okay, these, it can also be referred to as net assets. So let's look at the balance sheet over here. Now current assets, we just saw that it also contains inventories, your trade receivables, and cash. All of these are your current assets, and the total assets or net assets are basically what? Your current assets less current liabilities. It doesn't mention it over here, but if we were to calculate it, that would be 66 minus 73. Okay, and that will mean that the business is having a, you know, liquidity crisis. It has a negative working capital, which means it will need to convert some of its non-current assets into cash by selling some equipment or vehicles or etc. Okay, so it will need to raise up some current assets, but we'll talk about that later when we'll discuss ratios. Now we have liabilities. Liabilities are the opposite of assets. It's a debt owed by the business to organizations or individuals. However, as with assets, the same thing is that there are a number of categories of liabilities, which are your current liabilities, non-current liabilities, and there's equity, which is sometimes considered different than liabilities, a total different thing, but the basic idea is that assets equals to liabilities plus equity. So that's why sometimes you can say equity is kind of liability, and we'll see why we say equity is part of kind of liability. So let's look over here at this slide. So we have current liability. Current liability is basically a company's short-term financial obligations that are due within 1 year or within a normal operating cycle, also known as your working capital cycle. Examples include your accounts payable, short-term debt, dividends, and income taxes owed. So that's for current liability. Then we have non-current liability, which is basically long-term financial obligations that are due beyond 12 months in the future. So just like non-current assets which were retained for more than 12 years, this is liabilities that are due beyond 12 months in the future. So examples are your long-term loans, lease obligations, debentures, mortgages. All these are your long-term that you don't have to pay now, you have to pay that 12 months later. So let's look at that over here. We have that long-term loans over here. Okay, these are your non-current liabilities in this. They have written over here as well that other non-current liabilities might include debentures issued by the company. Then we have total equity. Then finally we have total equity, which is basically the money invested in the business by shareholders or owners, and that is also a liability. As if the company keeps trading, shareholders will hope for the repayment of their investment. So just in case the company has to halt its operation, the shareholders will want the investment to be repaid. So only in that particular situation will your equity be treated as a liability. That's why we say equity is sort of a liability but not completely a liability. This also includes your accumulated retained earnings, because whatever the profit business makes, it either gives them to the shareholders or keeps or plows them back in the business in the form of retained earnings. So that's why it represents the book value of a company, as it represents the sources of capital used. Okay, so whatever the profits the business made, it is kind of accounted in total equity, as it contains your shareholders equity and your accumulated retained earnings. Okay, it is also known as your shareholders equity. Now shareholders equity is equal to your total assets less your total liabilities. So whatever is the total assets, your total liabilities, that's your over here. So your total assets over here 508, total liabilities over here is 198. If you subtract that, then you have your total equity, which is over here. Okay, 310. This includes your share capital and your retained earnings reserve. Okay, share capital was the amount that was invested in the business by its shareholders, and retained earnings reserve means whatever the retained earnings, the cumulative value of the company's annual retained earnings profits. Okay, so the cumulative value, okay, the what has been accumulated over the past years. So that's how we got our retained earnings reserve. Now these are reserve does not mean that they are actually your cash reserves. That's one misunderstanding over here, that sometimes these are also referred to as your reserves, as it also contains retained earnings, but this is misleading, as these are not your cash reserves. Okay, these are what the retained earnings, what was the profit, the retained earnings that the business made in the past years, so that you can actually see what is the book value of the company. And finally we have your uses of statement of financial position. So hopefully you have seen all of those components and understood them well. We have assets, we have liabilities, current assets, current liabilities, non-current assets, non-current liabilities, and shareholders equity, which is total equity, that is shareholders equity, that which means the capital the shareholders invested, and your cumulative retained earnings or accumulated retained earnings, whatever you can say, which tells you about the book value of the company. Now, uses of statement of financial position. It helps to assess the liquidity of the business using working capital and calculating current ratios. Now, we can calculate working capital as we saw earlier. It is current assets minus current liabilities, and we'll also see ratios which we'll calculate later on. Liquidity ratios in particular. Then it also helps to identify cash flows, identifies where costs need reducing and reserves increasing. And then it helps to determine the financial health and performance of a business, as you can compare, see how much assets, where the business has used the assets, how much current assets does it had, how much non-current assets does the business has, etc. And it can be used for performance appraisal to see if performance has improved or not. You can see that with your previous performance. Okay, what was the total equity last year and what is it now, how much has it improved. And it is also used to see the amount of debt and the number of assets that the business has. Okay, as it clearly shows you the your assets, your liabilities. So that's it. And finally, statements of financial position are an essential source of information for a variety of business decisions and for a number of stakeholders. The precise information drawn from the statement of financial position will depend upon the stakeholder and the nature of the activity inquiry, which we'll look at later on the chapter. So that's all for today. Thanks for watching, and sorry there are few spelling mistakes over here. That's all. Allah Hafiz.